On the 15-minute time frame, we can clearly identify whether buyers or sellers are in control and use that information to trade only in the appropriate direction. Understanding market control helps reduce unnecessary losses and keeps us out of low-probability setups. Many traders rely on indicators to tell them when to buy or sell. However, indicators are reactive by nature. Market control leads price, and indicators simply follow. Section 1. Market Control Concept. In this concept, we identify order blocks on the 15-minute time frame and use them to determine which side is controlling the market. Whenever price approaches an order block, we consider two possible scenarios. If price approaches a bearish order block. Scenario 1. Reaction. If price reacts to the order block and does not close beyond it, control is with the sellers. Sellers remain in control until price reaches a bullish order block. In this room, we are only allowed to take sell trades. Scenario 2. Break. If price closes even 0.1 pip beyond the order block, control shifts to the buyers. Buyers remain in control until price reaches a bearish order block. In this room, we are only allowed to take buy trades. If price approaches a bullish order block. Scenario 1. Reaction. If price reacts to the order block and does not close beyond it, control is considered to be with the buyers. Buyers remain in control until price reaches a bearish order block. In this room, we are only allowed to take buy trades. Scenario 2. Break. If price closes even 0.1 pip beyond the order block, control shifts to the sellers. Sellers remain in control until price reaches a bullish order block. In this room, we are only allowed to take sell trades. Section 2. Choosing the right days for your system. Using this method, you actually have two options, depending on how price behaves on a given day. On days when market control changes frequently, meaning buyers and sellers keep switching control within the same price boundaries, the market is likely to be ranging, with price trapped inside a defined range. If your system is swing-based and targets larger moves, it's usually better to stay out on these days, unless price clearly breaks out of the range and holds outside of it. A valid breakout opens the door for larger targets. Without it, avoid trades that rely on extended take profits for a simple reason. Price movement is limited, making large targets harder to reach. These days are actually better for traders whose targets are smaller or more limited. On the other hand, if market control doesn't change much during the day, price is showing strong momentum and moving more in a trend rather than sideways. These are the perfect days to trade swing setups. Even traders using systems with smaller targets can sometimes increase their targets on these stronger trending days. Section 3. This concept can be used in two different ways. You can trade it as a standalone model, taking multiple entries with smaller targets. With this approach, the number of trading opportunities increases. However, this typically comes with a lower win rate. Or, you can combine market control with trend direction. When the controlling side aligns with the trend, you trade fewer setups, but your trades become swing trades, larger targets, higher probability, and a higher win rate. One important point I want you to understand is this. Having a high or low win rate is not the real issue. What actually matters is which type of system you can trade comfortably and consistently. In a high win rate system, your rules must be much stricter. Because of that, the market gives you fewer trades. To make this approach worthwhile, traders usually increase risk per trade, typically around 1%, up to a maximum of 2%. But before choosing this type of system, you must ask yourself a serious question. Are you psychologically comfortable risking that amount per trade? If the answer is no, then a lower win rate system may actually suit you better. These systems have less restrictive rules, which means the market offers more positions. Targets are smaller, and you focus on shorter-term moves. When trade frequency increases, both winning and losing trades increase. Losses can also come back-to-back. That is why in this type of system, risk must be reduced, for example, to a maximum of 0.5% per trade. In the end, this is a personal decision. Do you prefer lower risk with more trades, without combining control with trend? Or do you prefer higher risk per trade, fewer positions, higher win rate, and trading only when market control aligns with the trend? Neither approach is right or wrong. The correct system is the one you can execute without hesitation or emotional pressure. Later in the course, in the psychology and risk management sections of this course, we will break down in detail how win rate, risk per trade, and trade frequency work together, and how to build a system around your personality. Section 4. Examples on the chart. Example 1. Bullish price action. Let's look at a bullish scenario. Here, we have a bearish order block, but notice that price closed just 0.1 pip above it. That tells us control has now shifted to the buyers. They remain in control until price reaches this bearish order block. So in this room, we only take buy trades. The first thing we need for a buy is a touch to a higher time frame zone, like this one here. Then, on our entry time frame, we can enter using this change of character and this fair value gap within the order block. Take profit is completely up to you. It could be all the way to the opposite zone on the 15-minute chart, or a fixed 5 or 10. This depends entirely on your system, your backtesting, and your trading plan. Example 2. Bearish price action. Now let's look at a bearish scenario. Here, we had a bearish order block that held price for a while. After that, price broke this bullish order block, meaning sellers are now fully in control. Sellers remain in control until price reaches the next bullish order block, and in this room, we only take sell trades. To take a sell, the first thing we need is either a touch of a bearish order block or a break of a bullish order block. In this example, on the 5-minute chart, price touched this bearish order block. Then, on our entry time frame, after this touch, we can enter using the change of character and this fair value gap within the order block. If this video helped you see the market more clearly, like the video and subscribe for more smart money concepts education.